Welcome to Talk Tickers. Today, we are digging into TripAdvisor. The company just reported its fourth quarter numbers, and boy, did it cause a stir. Management tried to sell a story of a big, exciting transformation, but the market's reaction, well, it was swift, it was decisive, and honestly, it was pretty brutal. Let's get into it.
Yup, you're saying that right. The stock cratered more than 16% the day the numbers came out. Look, this wasn't some minor miss or a little guidance adjustment. A drop this big tells you one thing loud and clear. There is a massive disconnect between the story the company is telling and what investors are actually seeing in the numbers. So what on earth happened? And this really gets to the heart of it. TripAdvisor is out there pitching this fantastic turnaround story, this pivot to a brighter future. But the market? The market is looking at the financials, and they're just not buying it. At least, not yet. Let's break down exactly what spooked them.
So first up, let's look at the hard evidence. What were the numbers that sent investors heading for the hills? This is the market's verdict.
Here it is, the print, as we call it, on the street. You can see right away they missed on both the top and bottom lines. Now, the revenue miss was pretty small, nothing to panic over. But the real damage, it was profitability. Wall Street was looking for 13 cents a share in adjusted earnings. They delivered just 4 cents. That is a massive miss. And then you see that GAAP net loss at the bottom, a $38 million hole. That was the headline that just sank the stock.
Now, to really understand what's happening under the hood at TripAdvisor, you have to realize you're not looking at one company. You're looking at two, and they're locked in a battle for the future. And this chart just lays that battle out perfectly. On one side, you have the growth engines, the new businesses. Experiences revenue up a solid 10%, and TheFork, their restaurant booking platform, grew an awesome 22%. That's the future. But it's all being dragged down by that big blue piece of the pie, the old legacy hotels business, which actually shrank by 8%. So the new stuff is growing, but man, the old business is a heavy, heavy anchor.
And you know what? Management isn't hiding this. The CEO, Matt Goldberg, came right out and said it. This isn't an accident. This is the plan. They are deliberately shifting their focus and their money away from the old stuff to build up these new marketplaces. They know what they're doing. This is their strategy. So if the strategy is so clear, why did Wall Street hate it so much? And that's the million-dollar question. It all comes down to why the narrative, the story they were telling, just didn't land. It was like two different conversations were happening at the same time. You had management on their earnings call, and they were shouting from the rooftops about their momentum. Look, bookings are up 18%. We're building an experiences first future. But the market, they just looked past all that, pointed to the bottom line and said, yeah, that's great, but you lost $38 million, and your earnings were terrible. A story about tomorrow just doesn't carry as much weight as a big loss today.
Honestly, this was the textbook definition of a good narrative, bad print quarter. The story they're telling about the future, it makes sense, it's compelling. But the actual numbers, the print, showed a business that's struggling right now. The results were just too weak for investors to ignore. And if you dig in, you can see why the numbers were so rough. First, their profit margins just fell off a cliff, squeezed down to about 11%. Second, those cool new businesses, Experiences and TheFork, they're just not profitable enough yet to make up for the losses in the old business. And third, they had to spend a lot more on marketing to drive demand, which, you guessed it, ate right into their profits.
Okay, so that was a tough look back at the quarter. But what about the road ahead? Let's check out management's official guidance for 2026.
So for the full year, the guidance pretty much confirms that this tale of two businesses is going to continue. They're telling us to expect solid growth in both Experiences and TheFork, with better margins, which is great news. But, and it's a big but, they're also warning us that the hotels business is going to shrink even faster, declining by mid to high teens. It's a real race against time now. Can the new businesses grow fast enough to outrun the decline of the old one?
But then, in the middle of all this, management dropped a potential game changer. They've launched a strategic review for TheFork. Now, in Wall Street jargon, that is often code for, we're thinking about selling this thing. A sale could unlock a ton of value and make the whole TripAdvisor story a lot simpler to understand. This is a huge potential catalyst to keep your eye on.
All right, so with all that on the table, what does it mean for the stock? It's time for our final segment, the next call on Trip.
This is really the only question that matters for investors now, right? After you chew on this report and look at the guidance, what's the move? Is this a buy, a sell, or do you just hold on?
Looking ahead to the first quarter, we think the pain is probably going to continue. We're forecasting revenue to actually be down 3 to 5%. That legacy business decline is really going to hurt in what's usually a slower season for travel experiences. We also see earnings coming in below what people expect as those margin pressures stick around. The bottom line is, the stock is likely going to stay under pressure until TripAdvisor can deliver a clean quarter that proves this whole transition is actually working.
And that brings us to our reading, market perform. This just means we expect the stock to perform pretty much in line with the rest of the market. The bull case, the exciting story about experiences, is compelling, but right now it's just being drowned out by the drag from the legacy business. This has become a show-me story, and for now, we're in wait-and-see mode.
So how could you trade this? Well, here's an interesting idea. It's a hedged bet focused on that potential sale of TheFork. Here's the play. You'd buy TripAdvisor stock to capture the potential upside if they sell TheFork for a great price. But to protect yourself, you'd also buy some out-of-the-money puts. You can think of puts as an insurance policy that pays out if the stock falls. The idea is simple. You bet on the catalyst, but you insure yourself against the very real risks in the core business.
And one last very important reminder, this has been our analysis of the situation, but it is not financial advice.